Hi there. Are you thinking about repaying your student loan early? In 2026, that choice could cost you more than you expect.
All right, let's get right into it. We're going to tackle a massive financial question that so many UK graduates are wrestling with. Using some brilliant guidance from the tax experts at Pro Tax Accountant, we're going to figure out the absolute smartest move for your money come 2026. Should you be hammering down that student loan or boosting your pension? Let's find out. Does this sound a little too familiar? You're working hard, you're earning more, but then you look at your student loan statement and somehow the balance is actually bigger than it was last year. It's just so frustrating, right? You feel like you're running on a treadmill and going nowhere fast. So when you do have a bit of extra cash at the end of the month, what is the smartest play? Do you throw it at that debt that just feels like a weight around your neck, or do you put it to work for your future in a pension? That's the huge decision we're unpacking today, because with some big changes on the horizon for 2026, getting this right has never been more important.
Okay, let's get into the details. To really understand the best way forward, we first have to get a handle on the unique financial climate that UK graduates are facing. The experts are calling it a perfect storm, and for good reason.
You see, it isn't just one thing. It's kind of like a combination of three powerful forces all hitting you at the same time. You've got frozen tax thresholds that are squeezing your take-home pay. You've got new student loan rules kicking in. And on top of all that, you've got the psychological stress of watching that debt go up, even when you're making payments. Let's quickly talk about those frozen tax thresholds. They create something called fiscal drag. So here's how it works in simple terms. The income levels for paying tax are staying put, they're not going up. But hopefully, your pay is rising with inflation. This means you get dragged into a higher tax bracket much sooner than you would have otherwise. And the result? A bigger slice of your money goes to the taxman, and your take-home pay feels like it's shrinking.
So, with that squeeze on your cash in mind, let's explore the first option, powering up your pension. And this isn't just about saving for when you're older. Right now, it might just be one of the cleverest things you can do with your money. Okay, the magic ingredient here is something called pension tax relief. Put simply, it's a massive top-up from the government. Think of it like this. For every £80 you put into your pension, the government adds the £20 in tax you would have paid on it straight back into your pot. So you put in £80 and boom, it instantly becomes £100. That's a 25% return before your money has even had a chance to grow.
And this table just shows how incredibly powerful that gets as your income grows. Now look at the numbers for a higher rate taxpayer. If you pay 40% tax, that £100 going into your pension only costs you £60 from your pocket. That is an immediate guaranteed return of nearly 67%. I mean, where else are you going to find a deal like that? It's an absolute no-brainer.
And you'll definitely want to hear this part. On top of the tax relief, there's something even better, the employer match. This is, and I'm not exaggerating, free money. If your company offers to match your contributions up to, say, 5% and you're only putting in 3%, you are literally turning down a pay rise. Getting that full match is a 100% return on your investment. It should be everyone's #1 priority.
Okay, let's switch gears and look at the other path, the one that feels so tempting, getting rid of that student loan for good. Look, the psychological pull of being debt-free is huge, and it's completely understandable to want that weight off your shoulders. But, and this is a big but, we have to change how we think about this debt. A UK student loan is not like a normal loan. It doesn't behave like a credit card or a mortgage. It's much, much closer to a graduate tax. Did you know that the government itself predicts that the vast majority of recent graduates will never, ever pay it all back? After 30 or 40 years, the balance just gets wiped, gone. So what does that mean? Well, it means overpaying your student loan is only a winning strategy for a tiny, tiny group of people. We're talking about consistent high flyers. Think top surgeons, corporate lawyers, that kind of thing. People who are absolutely guaranteed to clear the entire balance, plus all the interest, way before it gets written off. For pretty much everyone else, any extra money you pay is just gone. It's money you never would have had to pay back anyway.
So how do you figure out if you're in that very small group? Well, the single most important piece of the puzzle is knowing which student loan plan you're on, because they are not all created equal. The rules, the interest, the write-off dates, they're all completely different.
This table gives you a quick idea. You could be on Plan 1, 2, 4, or the brand new Plan 5. And Plan 5 is a biggie, because repayments for those students start for the very first time in April 2026, and the terms have really changed. It is so important that you check your statement and know exactly which plan applies to you.
So let's just quickly compare the two most common plans for recent English grads. If you're on Plan 2, your loan's wiped after 30 years. But if you started uni more recently and you're on the new Plan 5, that gets pushed to 40 years. That's a whole extra decade of making repayments. This catches a lot of people out. It means that even more Plan 5 graduates are now expected to never clear the full balance, which makes the argument against overpaying even stronger.
Okay, we've looked at the incredible guaranteed returns from pensions, and we've looked at the weird reality of student loans. So let's bring this all together. Let's break this down into a simple, step-by-step playbook for how to use your money in 2026.
So what's the right move? Based on everything we've talked about, the fiscal drag, the tax relief, the employer match, and the different loan plans, the team at Pro Tax Accountant has created a really clear financial hierarchy. Think of it as the professional's guide to allocating your extra cash.
Stay with me. This is probably the most important takeaway of the whole conversation. You follow these steps in this exact order. Number 1, and this is non-negotiable, get that full employer match on your pension. It's a 100% return. Number 2, if you're a higher rate taxpayer, use your pension to cleverly manage your income and stay out of those higher tax brackets. 3, look into salary sacrifice if it's available. 4, build up other savings in tax-free ISAs for your other life goals. And then, and only then, at the very, very end of the list, should that tiny group of high earners even think about overpaying their student loan.
So you see the pattern here, right? For the vast majority of UK graduates, overpaying your student loan is the absolute last thing you should do with your spare money, not the first. The math is clear. Prioritizing your pension and other tax-efficient savings will build you so much more wealth in the long run. The emotional buzz of shrinking that debt just doesn't stack up against the cold, hard numbers. So there we have it, a clear hierarchy of priorities. It shows us that for most people, this isn't really a simple either-or choice. It's about following a smart sequence to make your money work as hard as possible for you. But of course, the big question is a personal one. This is a great framework, but how does it apply to your exact salary, to your specific loan plan, to your personal life goals, whether that's saving for a house or starting a family?
And that's exactly why it is so important to remember this is all general guidance. You know, it's based on the rules we expect in January 2026, but laws can change. Your personal situation is what really matters, so you absolutely shouldn't rely on this information alone to make your final decisions.
To make that choice with real confidence, you really need personalized advice. To build a plan that's tailored specifically to you, we strongly recommend you get in touch with the experts at Pro Tax Accountant. All their details are right there on the screen for you.
We really hope this has helped clear up what can be a really confusing and emotional topic. For more clear, actionable financial insights just like this one, make sure you subscribe to the Pro Tax Accountant channel. Thanks so much for watching.